Okay, let's start again. And today we are also again starting the revision session. This is the ratio analysis. This chapter is around 15 to 20% of total weightage. And this chapter is also very much important. Already we have covered the common sizing of financial statement, and if you have not watch my video, and then you can watch. I already have saved the videos, and this is the next unit. This is the ratio analysis. Especially we will focus on the ratio analysis, and if there is some concepts, and then we will also discuss for that concept. And our main focus is for the exam purpose only, and exam is coming very nearby, around 15 days 20 days after will be their exam. And now some of the candidate already may taking the exam also, and it started from May and June. 2 months will be there, and depending upon the candidate exam schedules. And if you are already appearing, and then that will be for the best of luck. But for me, and after around 1 month is there still. And now this is the revision session. Let's not discuss more about this exam details, because we have to revise lots of things still. Only one revision may not be sufficient, and we need to get a concept as well as all the practical questions, and all the concept of each and every unit as well, so that we can easily handle the examining questions. And let's start this question. Question number, this one is what total we have the 40 questions. Although that is the first question. First question is asking about that what this colony could increase its return on equity by taking which of the following actions with respect to the inventory turnover and use of equity financing. Colony expect to report net income of at least 10 million annually for the foreseeable future. Colony could increase its return on equity by taking the following action with respect to its inventory turnover and use of equity. This chapter is also very much important. Already we have covered the common sizing. Their option is given: inventory turnover increase and use of equity finance decrease, and inventory turnover decrease and use of equity finance increase. Inventory turnover and use of equity financing both increase. Inventory turnover and use of equity finance both decrease. Company is expecting to increase the income, and what will be the inventory turnover will increase, and use of equity financing also increase. Both will increase. Inventory turnover increase because sales will increase. Then inventory will increase. If inventory increase, then Inventory turnover will increase. Inventory turnover means what? Inventory total COGS divided by average inventory. Okay. First we have to remember all the formula, then only we can solve the question easily. And if you don't remember the formula, and this is mandatory to memorize the formula, right? But only memorizing formula is not sufficient. We need to understand the concept as well. Why this inventory turnover, whatever, suppose other current ratio, current ratio, quick ratio, sweetest ratio, whatever formula are there, we need to understand the concept. And if we need to understand the concept, that will be easy to memorize the formula as well. Okay. Suppose return on assets formula, net income divided by average total assets. And net income, return on assets. Return means what? Return means income, assets, whatever asset we have utilized to generate the income, right? That will be the denominator part. And same thing. And why there is the average total assets? This average total asset, there is a concept. While we are utilizing the asset to generate the income, that asset may be the sum of the assets belonging to the past year, and that some assets used for the full year, and some of the assets may not be used for the whole year, because asset we purchase at the year in the middle of the month, in the middle of the year. In that case, full asset, total asset, we cannot utilize to generate that income. That's why we always make the average total assets. That's this average total asset is opening assets plus closing assets divided by 2. That's come to the average total asset. Okay. In this case, net profit increase, inventory turnover will increase, inventory will increase, COGS will increase, right? And average inventory will also increase with that may not be comparatively increase, may not be increase as proportionate to increase in sales. Inventory turnover and use of equity both financing decrease. This is not correct. Inventory turnover and use of equity finance both increase. Inventory turnover increase, use of equity finance decrease. Inventory turnover decrease, use of equity finance increase. This option C is the correct answer. Now, question number 2. Common stock. Common stock means equity. For a beverage company has a current market price is 34. Market price of that share is 34. Beverage company estimate to earn 2 per share. EPS, earning per share, is 2 per share and next year, and then average price earning ratio of the company beverage is 15. Okay, P ratio is 15 and EPS is 2, and what will be the market price of the share? Market price, that market price of this share will be the EPS will be the what formula? Market share divided by earning per share equal to P ratio, right? P ratio means how much different from the earning per share and market price. What the market is offering to the company, what is the exactly earning per share of the company. Suppose EPS, same is here is already given EPS and divided by market price. Suppose market price is X divided by 2 equal to 15, and 15 multiplied by 2, 15 multiplied by 2 equal to market price of this share, company share, beverage company share. Okay, and total will be 30. Okay, and market price as per this EP ratio, market price will be the 30, and using the earning per share ratio, the company comparable valuation method, beverage company stock, this beverage company stock is overvalued or undervalued, because as per P ratio, the market price, the value of the share, will be 30. Okay, sorry, that is value of share. Value of the share will be the 30, and market price, now that market trading in $34. It means if our share value is 30 and is trading in market in 34, means what? Is more than our share value in trading in market. It means $4 more than the real value of the share. It means overvalued, $4 overvalued. Okay, and now question number 3, selected financial data for the buyout corporation are as below. This cash January and December. What is the meaning of this 2 month separately given the financial data? Maybe there we need to make the average. I don't know, but let's read the requirement of this question. Beyond's net income for the year was $96,000 beyond current ratio at the end of the year. Okay, it means this is asking only the current ratio end of the year, and this is January 1 and 31st December. This is beginning and the year end. It means January, suppose January 24 started and 31st December will be ending. This is 1 year data is given. Okay, and beyond current ratio at the end of the year. Current ratio is what? Current ratio is simplest formula, current asset divided by current liability constitute current ratio. Okay, current ratio at end of the year, and cash 62,000 plus receivable 47,000 plus trading security 35,000, inventory 138,000, and plant and equipment, this is not a current assets. Okay, 282,000 total as current asset minus current liability. This 182,000 total current asset, and current liability will be the account payable 84,000, and accrued liabilities 11,000, and deferred tax. Deferred tax can be long term as well as short term, right? There is not specified deferred tax whether long term or short term, but we assume that this is short term. Suppose 9,000 equal to 104. Okay, 282 divided 104 is come to 2.7. 2.71. Option number C is correct answer, and we assume that deferred tax is current asset, will be payable within the next month, next year. That will comes to the current. And now in question number 4, Oslo Company's Industrial Photo Finishing Division RO incurred the following costs and expenses for the year 2001. Direct material 200,000, direct labor 150,000, factory overhead 70,000, and fixed factory overhead divided into two parts, and one is fixed and another is variable. 70,000 is variable and 42,000 is fixed, and general selling and administrative 30,000 variable and 48,000 fixed. In total will be the 450 will be variable and 90,000 should be there, not 90, only 90,000 is the fixed. And during the year 2001, RO produced 300,000 units of industrial photo prints, and which were sold for $2 each. Oslo investment in RO was 500,000 and 700,000 in January 21 and December 21 respectively. The Oslo normally imputes interest and investment at 15% average investment capital for the year ended December 2001. RO return on average investment was return on average investment, direct material, direct labor, selling. Total total sale value is 300,000 units produced multiplied by 2 is come to 6 lakh, and it is sales value. Okay, and minus direct material 200,000 minus direct labor 150,000 minus factory overhead factory overhead 70,000 minus 30,000 selling and general expenses minus 42,000 minus 48,000 is 60,000, and 60,000 500 plus 700 divided by 2 is come to 600. 60,000 divided by 600,000, and this come to the 10%. 10% is the correct answer. Now we are in question number 5. The Devil's company has a short-term cash need and plans to take out a 120 days promissory note. What effect will this transaction have on the long-term debt to equity ratio? Long-term debt to equity ratio to hold no change, because this is promissory note 120, this is not long-term. Okay, no change. Equity to debt. Long-term debt to equity is no change, and equity to debt decrease. Equity to debt decrease. Debt increase, equity decrease. This is correct. Now question number 6. Account receivable turnover will normally decrease as a result of account receivable turnover. Okay, account receivable turnover. Account receivable turnover is normally we understand that account receivable means those which we made the credit sales, and account receivable turnover formula is the net credit sales divided by average account receivables. Account receivable means average account receivable means at the beginning of the year and ending of the year. Average, if we make the average, then this will come to the account receivable turnover formula. Okay. and account receivable turnover will normally decrease as a result of what? Write-off of uncollectible account. Uncollectible account, this is writing of uncollectible amount is already we have classified as bad debt, and then that will not affect on the account receivable turnover, even that one written off. An increase in cash sales in proportion to the credit sales. Cash sales increase, this will the correct answer. If cash sales increase and credit sales decrease, then this turnover, account receivable turnover will decrease. Okay. And question number 7. Which of the following inventory cost flow assumption will result in higher inventory turnover ratio in inflationary economy? Economy is inflation, too much inflation, and cost assumption, higher inventory turnover. It means inflationary economy means what? Inflationary economy means frequently changing the product price, right? Whatever the price are changing frequently. As compared to last year, this year there already increase inflation. If there is inflation, then product price will increase. All the product consumable items and expenditure will be proportionately increase. Rent will be increased. Fixed cost will be increased. Everything will increase. In that case, last year inventory purchase rate and current inventory purchase rate will be different. Okay, that inflation will be the different, and in this situation, such kinds of market, what will be the inventory? What will be the reason of inventory increase? Right now, whatever inventory we are showing in our book of account, that will be the higher. The reason is FIFO, LIFO, and specified identification. All these are not correct. This is simple LIFO. Last stock purchase we sell in first. Last in first means LIFO. Okay. Now in question number 8. A financial analyst is analyzing the account receivable period for the three companies by the comparing their days sales in receivable. The financial analyst has collected the following information for the companies. There are three companies A, B, C. Okay, net credit sales is given, and average account receivable in net is given, and average allowance uncollectible accounts is given, and if each of the company has credit terms of 30 days, the financial analyst is most likely to conclude which of the following: credit is 30 days, and company B is the least efficient in the collecting payment. In this case, what will be we will calculate? First of all, account receivable turnover. Account receivable turnover which has the highest. Let's calculate. Okay, account receivable turnover means average receivable given, and cost of goods sold. Net credit sales given, and this sales is given, and credit sale is given. Credit 175 divided by 10,000. 10 it's coming over 17.5. 145 1000 divided by 20,000, it's come to 7.25. Okay, 7.25, and 225,000 divided by 11,500 is come to 19.56. And now day collections, we have to calculate day collections, and this 175 divided by day collections is B. B is the least efficient in payment and collection. Yeah, B is correct. Is correct because if we calculate day collection is 145,000 divided by 20,000 equals 7.5. 360 divided by 7.525 is come to the 49 days. So there are not 49 days. That's why B is the list. Okay. Now in question number 9. Now we is in question number 9. What is the requirement? Based on the information above, select the strategy that would fulfill the Stone's objective. What is the Stone objective? There is a given company Go, Astro, Shenzhen Industry. These are given. Total sales given, net profit margin given, current ratio given, return on asset given, debt to equity ratio given, financial leverage is given. The question is saying Stone Bank has received loan applications from the 3 companies in the computer service business and will grant the loan to the company with the best respect of fulfilling the loan obligations. The specific data shown below has been selected from these applications for review and comparison with industry average. Option A say the Stone should grant loan to company Go as all the company's data approximate to industry average. Company Go. Current ratio, Astro has the highest, and return on asset, industry, Astro has the highest, and debt to equity ratio, Astro has the lowest, and financial leverage 1.02, Astro has the lowest. Stone grant to loan is all company data present industry average, and industry 1.33 is average, and 4.39, 1.495, and 4. Astro should grant a loan to the Stone should grant the loan to Astro both debt to equity ratio and regular financial leverage below the industry average. And Astro should grant to the loan to the Shenzhen. Shenzhen is not a good choice, and Astro should grant a loan to none of the others. Option B is the correct answer, because now question number 10. Ratio are used for the many purposes in financial statement analysis to determine the return on investment for a company. The numerator of the fraction used should be a numerator income before non-recurring item and before income tax. Ratio used many purposes of financial statement analysis to determine the return on investment. Okay, return on investment. What will the return on investment formula? Return whatever return divided by investment, simple ratio. Okay, income before in non-recurring item and before income tax. This is not correct. Income tax should be deducted. Option B, income before non-recurring item and after deducting preferred dividend. This is not correct. Income before non-recurring item. Income before non-recurring item plus interest expenses net of tax income. Return on investment of company, they determine the income before non-recurring item plus interest expenses net of income tax. Income before non-recurring item and before income before income tax. Before income tax should not be return on income before non-recurring item and after deducting preferred dividend. Income before non-recurring items. This should be after preferred dividend. Preferred dividend is mandatory. Let's question number 11. Now question number 11, our company has return on equity 18%, return on asset 10%, and dividend payout ratio is 60%. Company's sustainable equity growth rate is what? Okay, no, there is a formula. Sustainable equity growth rate formula. Solvency. Also solvency. Sustainable growth. Now we have to calculate the sustainable growth rate. Okay, sustainable growth rate will be the dividend payout, net income divided minus dividend payout, dividend divided by equity. Retention ratio multiplied by return on equity. Also another formula: return on asset, return on equity 18%, retention ratio, payout means 60%, retention ratio will be 40%. Okay, and payout is 60%, retention only 40%. Okay, and return on equity is 18%, and return on assets 10%. Return on equity 18%. Okay, and return on assets 10%, and payout 60%. Now sustainable growth rate we need to find out. Okay, in this case 40% will be the retention. Already we told you. Growth rate will be return on equity multiplied by return on equity 18% multiplied by 4, 7.2. Simple. Okay, now all of the following are the affected when the merchandise is purchasing on credit, except credit purchase. Total current liability will be affected, net working capital will be affected, current ratio will be affected, total current assets. Credit purchase means whatever total current assets. Total current asset will increase if purchasing credit. No, current asset. Net working capital will not be affected because purchase on credit equal to increase the inventory, stock, and increase in liability also. Total current liability, total current asset, current ratio, net working capital, current asset minus current liability. Okay, selected information for the is Eton company is as follow. Preferred stock 8% per 100, non-convertible, non-cumulative 125,000, 125,000 in 2008-2009. Common stock 300,000, 400,000, and dividend paid on preferred stock your indeed 10,000, and net income for the year indeed 60,000, 120,000, and basically return on common stockholder equity rounded to the nearest percentage of point is return on common stockholder. Means that is preferred stock, common stock 300, 400. Okay, non-convertible, non-cumulative preferred stock, and common stock is 300,000 plus 400,000 divided by 2 is equal to 350,000, and dividend pay 10,000 and 2009 120 divided by 350,000 into 100. No 120,000. Net income for the year ended 120,000 minus, and preferred stock 10,000 is come 120,000 minus 10,000, 100,000, and return earning also there, return 75,000 plus 185,000 divided by 2, 130 plus 350, 480, and 120 minus 10,000 divided 480, it's come to 22.923%. Okay, now in question number 14, okay, a wholesale supplier has collected the following financial data on 3 companies that only purchase their product for resale to retail consumers. Company A, Company B, Company C, sales given in euro, and 100,000 euro, 1250,000 euro, 2,450,000 euro, and gross profit margin 20%, 30%, 25%, beginning of inventory 35,000, 80,000, 155,000, ending inventory 65,000, 22,500, 175,000. On the basis of above information provided, the supplier is able to conclude that Company A and Company C both are turning the product inventory faster than B. It's asking about the inventory days sale. Okay, how can we calculate this one? First, inventory beginning 35,000, average inventory plus 65,000 divided by 2 is come to 50,000. Average inventory for company A. Gross profit margin 20%. 100,000, 1,000 means 1 million. We can say simple 1 million. This is a gross profit margin. If we reduce 1 million divided 1.1, it's come to the COGS divided by 50,000, it's come to the 16.67. 360 divided by 16.67 is come to the 21 days, and other case 1, 2, 1250 1.25 million 1.25 million divided by average inventory 80,000 plus 225 equal to 350 divided by 2 is come to the 1,525,000. 150 divided by 1.3 divided by 1,525 thousand. It's come to 6.3. okay, and 360 divided by 6.3 is come to 57 days. Another option is 155,000 plus 175,000 divided by 2 165 and 1250 divided to 1.25 is come to divided 125 155,000 plus 175,000 divided by 2 is going to 165 and 245 million divided by 1.25 divided to 165,000 is come to the 11.87 360 divided by 11.87 is come to 30 days. Company A and company A both are turning the product inventory faster than B. This is correct. Now question number 15. Basic earning per share is computed by dividing. Earning per share is simple. Net income divided by number of equity shareholder outstanding. Simple. That formula. Net income divided by weighted average common share outstanding. Simple. This first answer is correct. Net income ending common share. This is net income available for common sorted by ending common outstanding share. Net income divided weighted average common. This one is correct. No other option need to go. Now we are in question number 416. Okay. Now we are which question number are you talking? Net working capital. Now in question number 15, basic earning per share is computed by dividing, right? Now question number 16. I am very happy some of the participants are giving the answer as well. Comparing the ratio of the company against the same ratio for a group of companies from the same industry is example of what? simple ratio analysis, trend analysis, dew point analysis. Which one is the correct answer? Waiting for answer. If you have the correct answer, you can answer, and that will be the good. Dew point analysis, trend analysis, simple ratio analysis, comparative analysis. Comparative analysis simple. Now in question number 17, just read the requirement of these questions. Okay. No doubt was paid during the year. How much does the company's return on total asset increase between year 1 and year 2? Return on assets. We have to check the return on assets only. At the end of the year, one company had average total assets. This is given in yen. Okay, 450 million. Average total liability 150, and net income 350 million. 35 million. Sorry, the company's management projects average total asset to increase by 50 million. Average total assets increased by 50 million in year 2 due to the planned purchase of new manufacturing plant. The company will issue 330 million of new debt at the beginning of the year 2. No debt was paid during the year 1. If the company's management project net income increased by 25% in year 2, approximately how much does the company net it? Now we have to calculate that net income 35 increase by 25% means plus 25% is 168. Okay, 168 means 135 plus 25%, 168.75. This is the new income, and return on assets will be assets year 2. Asset total, how much asset? Year 2 will be increase 168.75. Total asset 450 plus increase by 50 million equal to 500. It will come to 500 assets. Okay, due to the plan purchase new, and that also increased by 3 million. Okay, return on assets. Return on assets, what? Earlier were 135 divided by 450 is come into 100 equal to 30%, and 30% return on assets, and now his return on asset will be 135 plus 25% increase divided by 500. 33 into 100, 33.75. 30 now minus 30, 3.75. How much increase? 3.75. Your 2 to your 1 divided by 450. 450 or what? This is 3.31. Okay. 33.33 and net working capital not be affected because purchase and credit input. Now in question number 18, okay, now question number 18, return on investment is used an important measure of how effectively management is using the capital investment in a company. If the standby company has sales 100,000, net income 15,000 and assets of 400,000, the organization return on investment increase. Return on investment is used as important measure of how effectively management is using the capital invested in company. If the standby company has sales of 100,000 and net income of 15,000 and assets of 400,000, the organization return on investment will increase if option A, net income is increased by the same dollar amount that total assets are increased. Option B, sales are increased by the same dollar amount as expenses. Option C, net income is increased by the same percentage as total assets. And option D, new assets are purchased resulting in the increase in sales but the same net income. Now, which one will be the correct answer? And let's calculate the return on investment, ROI. Net income divided by total assets is the return on investment. Okay, and total sales is 100,000, net income is 15,000, and total assets 400,000. Return on investment will be 3.75%. Okay, now what is the option is saying? Then net income is increased by the same dollar amount that total assets are increased. Example, net income plus 10,000 equal to 25,000. Okay, assets, total asset plus 10,000 equal to 410,000. Okay, example, this is a new rate of return on investment will be 25,000 divided by 400,000. What will be the ratio? This come to the 6.1%. This ratio increase. This is possible correct answer. Net income is increased by the same dollar amount that total assets are increased. Okay. Option B, what is it? Sales are increased by the same dollar amount as expense. This has no impact on net income. So return on investment remain unchanged at 3.75%. That this is not a correct answer. Option C, net income is increased by the same percentage as total asset increase. Suppose both increase by 10%. Net income will be 16,500 if we increase by 10%, and asset will be the 440,000, and ratio will be the 3.75. Ratio remains same, not correct. Okay, ratio remains same. Option D, new assets are purchased resulting in increase in sales by the same net income. It means the asset increase, net income remain the same. Return on investment decrease, not correct. So question number A, this is the possible correct answer, not other option are correct. Now question number 19. Merger. Halifax, Chief Financial Officer of Strickland Construction, has been tracking the activities of the company's nearest competitor for the several years. Among other trends, Halifax has noticed that this competitor is able to take advantage of new technology and bring new product to market more quickly than the Strickland. In order to determine the reason of this, Halifax has been receiving the following data regarding two companies, Strickland and competitor. Account receivable turnover 6.85 and competitor 7.35. Return on asset 15.34 and competitor 14.74, and times interest earned 15.65 and competitor 12.45, and current ratio 2.11 and competitor 1.13. Debt to equity ratio 42.16 and competitor 55.83. Degree of financial leverage 1.06 and competitor 1.81. Price earning ratio, P ratio 26.56 and competitor 26.15. On the basis of the information, which of the following the best strategy Halifax to follow the attempting improve the flexibility of Strickland? Option A, seek additional source of outsourced financial for new product introductions. Option B, investigate to way to improve the efficiency and turnover times to improve liquidity. Option C, seek cost cutting measure that would increase Strickland profitability. Option D, increase the Strickland investment in short-term security to increase the current ratio. Now we have to analyze each and every questions with reason. Correct. Now we have to analyze all the questions details. The key observation: what will the account receivable turnover? $6.85 Strickland and competitor 7.35. Interface: a competitor collect the receivable faster, better liquidity and operation efficiency, right? Account receivable turnover means if there is a more than the this stick land, then it means that will be the faster collection period, because day collections account receivable, that day collection will be the total days in a year divided by that account receivable turnover. Suppose account receivable turnover stick land has the 6.85, and what will the day collection days total 365, suppose assume in a year, divided by 6.85 will be 52.55 days. Okay, and what will the competitor will be 365 divided by 7.35 is come to the 48.9, and this is faster than stick land. Okay, and return on assets. Okay, return on assets. Option A, account receivable competitor is faster collection. Return on assets, Strickland has 15.34%, and competitor has 14.74%. Interpretation, what will the Strickland is healthy rather than competitor, is a positive point for the return on assets. And times interest on Strickland has 15.65%, and this is not percent, this is times, and competitor has 12.45. Strickland has a better interest coverage, lower financial risks. Okay, these two options are good for Strickland. And current ratio, Strickland has 2.11, and competitor has 1.23. The interpretation, Strickland has 2.11. This more current ratio is also not good, always not good. Strickland is possibly maybe the too much conservative, holding current assets, right? This always too high current ratio also not good. And debt to equity ratio, that is financial leverage, and Strickland has 1.06, and competitor has 1.81. In this case, competitor uses more leverage, right? Potentially more aggressive in funding, innovation and growth. Strickland has lower than competitor, and in this case, what? This is the positive for the competitor, because competitor is more leveraging, potentially more aggressive in funding, innovation, growth. Maybe if you if you take the external funding, then only business will grow. We cannot grow always from our one funding or one capital only. We have to take loan from the outside, or we have to issue our share to increase our fund, increase our business. That's why this is more positive aspect for the competitor rather than Strickland. And other price earning ratio is both are approx same, 26.56 and 26.15, approx same, very close. Okay, and how what will be the conclusion? More conservative, Strickland is more conservative, right? And high liquidity, current ratio is high, and lower financial leverage is lower receivable turnover, right? and competitor take more financial risks, uses asset more aggressively, possibly reinvestment cash faster into the production development. And what will the best strategy and what will the correct answer here? Correct answer: competitor bring new product faster, likely due to better operational efficiency and capitalizations, not necessarily higher profitability. Okay, whatever competitor is doing is not always maybe the profitable, right? That's why the answer will be the what? Investigate way to improve the asset efficiency and turnover times to improve liquidity. Faster turnover, faster cash flow allows investment in research and development and innovation, improve returns without sacrificing the profitability. Other options, that is others, outsourcing financial does not address the internal delays. Profitability always strong. Current ratio is already high. More than short-term investment may be reduced the flexibility. That's why B is the most strategic answer. Last year, a company had sales 100 million, net income is 10 million, average total asset of 90 million, and average equity 40 million. This year had sales 120 million, net income 14 million, and average total assets of 100 million, and average equity 50 million. How did the total asset turnover ratio and return on asset change respectively? Option A, increase decrease. Option B, increase decrease. Option C, decrease increase. Option D, decrease increase. Now let's analyze the questions. Last year 100 million, income 10 million, 90 million of total average asset. Average equity was 40 million. This year it had sales 120, sales increase, net income increase, and total assets also increase, and average equity also increase. Okay, total asset turnover ratio. Total asset turnover ratio means what? Net income, how much income? This your income 14 divided by asset turnover. Asset, total assets 100, 14 divided by 100, 0.4, and earlier was total asset was 90, 1 divided by 90. This is increase, okay. Change increase, okay. And return on asset change increase. Okay, turnover ratio, total turnover ratio means 10 divided by 100. Now turnover ratio 14 divided by 120. Increase. Okay, and based on the year option, which one increase, decrease? Correct answer, both increase. Option A. Okay, now question number 21.